years of COVID-related restrictions, travel demand is back with a bang. The demand momentum is expected to remain strong over the next 2-3 years. The hotel industry is on an upswing, and hence we recommend buying Royal Orchid hotels as our pick in the Discovery series. Royal Orchid's earnings are expected to grow strongly over the next couple of years, given the industry upcycle, rapid expansion plans, and robust margin improvement owing to lower cost structure. A strong balance sheet with debt to equity of 0.7x owing to an asset-light approach makes the company well poised to reap the benefits of a demand surge. Attractive valuations make Royal Orchid a compelling pick to play the strong demand momentum in the hotel space. While the stock is trading close to its all-time highs, we see that there is still potential for significant re-rating. The company operates hotels under Royal Orchid as well as Regenta brands. It has a strong portfolio of 75 hotels and resorts with about 4,500 keys spread across 48 locations and 11 states. It has a diversified portfolio with properties spread across leisure, business, spiritual, wildlife as well as hill stations. It operates mostly in the mid-segment, which is 3-star to 4-star hotel properties. Remember, FY22 average room rate was about 3,500 rupees. Royal Orchid follows the asset-light approach with about 76% of the keys under management contract route. For managing hotels, the company signs long-term agreements, typically of 10 to 15 years, which provides healthy growth visibility. Over the past few years, Royal Orchid has scaled up its business with the share of managed rooms increasing from 67% in FY17 to about 76% in FY22, which indicates huge acceptance of the brands both among consumers as well as hotel owners. Royal Orchid has a loyal member base of about 2.6 lakhs, which also indicates a strong brand pull. After a gap of 2 years owing to COVID restrictions, travel demand has come back very strongly. Leisure demand led the momentum, posting a strong comeback in the second half of FY22 as soon as COVID wave 2 subsided and restrictions were eased. Even the corporate demand has come back very strongly from the start of FY23 onward as offices reopened and business events, corporate meetings, all of that resumed. Royal Orchid witnessed strong demand momentum, posting a revenue growth of 24% in Q1 FY23 as compared to Q1 of FY20. Given the strong growth prospects over the next few years, Royal Orchid has robust growth plans. It aims to reach a room count of about 7,500 to 8,000 by the end of FY24 as against 4,484 keys as of FY22, which is about 70 to 80% growth from these levels. It already has a strong pipeline of more than 1,000 rooms in about 17 hotels, which are likely to come up in the current fiscal itself. Royal Orchid would continue to expand in the mid-market space, which has been its core segment of operations. Royal Orchid reported sharp margin improvement as demand surged. In Q3 FY22, which is post the end of second wave of COVID-19, and even in Q1 FY23, which was after the third wave, Royal Orchid's margins crossed the 30% mark, a sharp improvement compared to FY20. The company had significantly lowered its cost structure in the times of COVID. It optimized its manpower expenses and cut down its power and fuel expenditure. The company reduced its fixed overheads such as corporate expenses and other costs. We believe the margin improvement is sustainable. It has already incurred bulk of the initial expenses for hotel management business, which is necessary employees for obtaining new business, setting up the business infrastructure and creating a brand for itself in this space. As the hotels under the management contract route increase, the company can leverage benefits of scale, resulting in better margins going forward. Now, if we compare Royal Orchid with Lemon Tree Hotels, which is also a reputed hotel player operating in the mid-market segment, while Lemon Tree's operating margins are better compared to Royal Orchid's, the latter posted profit in FY22 at the net level compared to a loss posted by Lemon Tree. Now, this is owing to the asset-light approach of Royal Orchid, which leads to much lower depreciation as well as interest expenses. Royal Orchid's return ratios are better than Lemon Tree's owing to this asset-light approach. However, Royal Orchid is trading at a significant valuation discount to Lemon Tree. And if you look at the valuations, at the current market price, the stock is trading at 8 times its FY24 EV to EBITDA projections, which is a sharp discount to also its long-term historical average valuation multiple of 13x. Its valuations clearly have significant re-rating potential from the current levels. We therefore advise investors to add the stock to their portfolio.